Hi, this is Nancy with Lock Rate Mortgage, and this is your Fast Mortgage Insight. Today we're going to talk about escrow account.
Darling, you got to let me know.
Is it better to impound your taxes and insurance?
So you got to let me know.
Or should you pay them on your own?
Should I stay or should I go?
Before we talk about the pros and cons, let's cover the basics. What is an escrow account? When you own your own home, aside from your mortgage payment, you're also responsible for paying property taxes and insurance. Your lender will give you the option to create what's called an escrow account. This is an account that allows you to plan for the expenses by collecting a portion to set aside each and every month. When the bill comes due, the lender is able to use those funds to pay your bill. Generally, you would normally impound only your property taxes and your homeowner's insurance. On the side note, homeowners association fees would not be impounded usually in your escrow account. So naturally, the benefit of having an escrow account is for convenience. It's an easy way to manage your property taxes and insurance. It's one of those things that you can set it and forget it.
Just set it and forget it. It's as simple as that, folks.
You don't have to worry about missing payments or due dates because with property taxes, for example, the lender knows the deadlines. For example, in California, the first installment is due in November and the second installment is due in February. And so usually around that time, the lenders will mail out your check. And likewise, for homeowners insurance, your carrier will actually send the bill directly to the lender and they'll mail out the check when it's due. Now, more importantly, let's talk about the math.
But it's hard.
And let's understand how an escrow account is actually set up. If you're purchasing a home, to estimate the property tax bill in California, they'll usually go off of 1.25% of your purchase price. So say you're buying a home for $800,000 times 1.25% of the estimated tax rate, your property tax bill will be about $10,000 a year. So for your escrow account, if we're setting it up, we need to set aside a monthly amount to cover the bill by the end of the year. To calculate that, you take the $10,000 bill divided by the 12 months out of the year. That gives you $833.33 is how much the lender would want to collect on a monthly basis. Here's something many buyers and even borrowers who already have a mortgage and are looking to refinance don't realize, or maybe they do, but they don't fully understand. Number one, lenders all usually pad your escrow accounts by 1 to 2 extra months to make sure that in case something were to happen, they need to be able to cover your bill when it's due still, because that's a responsibility of an escrow account. So they need to also forecast in case you miss a mortgage payment or something happens. Number two, regardless whether you're purchasing a home or refinancing, the lender needs to form your escrow account, and they don't just collect 1 month of taxes and 1 month of insurance when setting it up. Here's how it works. Say you're refinancing now in June and you close your loan next month in July. So hypothetically, say your first mortgage payment will be due in August. Well, in California, technically, your next installment on your property tax would then be due in November. Using our example earlier of $10,000, half of that installment's due in November, so that's $5,000, which is 6 months worth of payment. In that example, you would have only made 3 payments, which is August, September, October, and now your bill is due in November. So you would have only paid $833.33 times 3 months. That gives you $2,499. $2,499 is not $5,000 to cover your first installment. Therefore, when forming the account, the lender will account for those 3 missing months plus the 2 padded months that I mentioned earlier that they usually collect. So that's 5 months that they would need to collect for when setting up your account. That's $833.33 times 5 months gives you $4,166.65 that you'll have to pay up front in creating the escrow account. That way, by November, you'll have at least made 3 payments that add up to $2,499.99, plus that $4,166.65. Well, that gives you a total now of $6,666.64. That gives them $5,000 they need to pay the first half of your property tax installment, which is 6 months worth of payment, and still have a small cushion of about $1,600 for the emergency in case you ever miss a payment. Okay, stay with me now. Let's do the same quick math for homeowners insurance premium, if you choose to impound those as well.
I have absolutely no idea what's going on.
Say you're buying that home for $800,000. The average insurance premium in California to cover the minimum dwelling coverage is 0.3% rate. So your homeowner's insurance premium, you would take that $800,000 times the 0.3% would give you $2,400 is your annual premium. You take that divided by 12 months gives you $200 a month, and that's how much the lender would collect on a monthly basis. If you're buying and you like to bind that policy, the lender would need to collect the full $2,400 upfront to pay your premium. In addition, as I mentioned before, lenders will usually pad at least 1 to 2 months in case of an emergency for that premium. So in addition to that $2,400, they'll usually collect at least another $200 for that padding. So to form your new escrow, collecting the homeowner's insurance portion, they're going to set aside $2,600 now. Okay, just a piece of information on the opposite side. So say you're refinancing, just like the tax scenario going back, it's June now, and depending on when your policy is set to renew, let's just say in this example, your policy is due in April. Well, if your first mortgage payment, as I mentioned, is due in August, by April, you would have made 7 mortgage payments. So the lender would be collecting $200 a month for those 7 months as you were making your mortgage payment. That's $1,400. And like I said, if our annual premium was $2,400 and we've only collected $1,400, of course, that's not enough to cover your insurance premium when it's due. We're short. So therefore, when forming your escrow account, they'll want to collect 5 months to make sure you have enough to cover the full 12 months. 7 and 5 will give you the 12 months for your annual premium. 5 months times $200, that's $1,000 that they would collect now when they're forming your escrow account. So let's add that all together, right? That was a lot of math for a minute, and let's recap.
That is really dog and bugs. Genius.
When we're forming the escrow account and you're purchasing a home, the lender will require you to come up with $6,766.65. That was $4,166.65 for our taxes, plus $2,600 for our insurance. That's in addition to your down payment and closing costs that you would have to come up with now. Or using the other scenario for the refinance, you would have to come up with a total of $5,166.65. That was $4,166.65 for your taxes, plus $1,000 that we need for the insurance, and you would come up with that up front. Or your other option is you can roll that amount into your loan, so you don't pay up front, but you would be raising your loan amount by $5,000 or so to cover that, which means if you raise your loan amount, then your mortgage payment would be slightly higher because now you added $5,000 to your loan. So here's my summary. Escrow accounts are great. They're convenient, but just keep in mind, if you're not coming up with the money up front to form the escrow account, that convenience comes at a small price.
A small price to pay for salvation.
And yes, property taxes and insurance are bills that you would have had to pay one way or another. But if you can manage your bills and set that money aside on your own, you would save money on not raising that loan amount, or just for the convenience of not having to come up with that extra cash up front now. And that has been your Fast Mortgage Insight. See you next time.